from WBRN Radio and on the Bostonred Network. From the Numbers Man part this week in economics on the 4th of March 2019. We'll cover a number of topics today. We'll talk about PMIs from ISH market on U.S. manufacturing, and I believe we also have one other PMI to look at here from the China manufacturing PMI. Anyway, those will be the two PMIs we'll look at. We also will look at a theory here, a monetary theory. Modern monetary theory is not a recipe for doom. This is by Dr. Kelton, Stephanie Ann Kelton. Used to be at the university in Kansas City. Now she is at the is she at Stony Brook? She's moved on. Yeah, she's at Stony Brook now, so she is there, and she is writing in the Bloomberg publication on the 21st of September. Of January. Many economists have talked about this, including about, but not limited to some Nobel laureates in economics. We can think of Paul Krugman here and his take on modern monetary theory. We'll talk a little about modern monetary theory, and when we finish, we have a little, it's about 10 minutes from Dr. Kelton here, where she describes what modern monetary theory actually is. We've had instances of the last 10 years, particularly during the Depression that came in 2008-2009, that there had to be a modification of what I suppose one would call modern Keynesian theory, and it moved towards this. Now, the issue here basically is around 2 points. Inflation, and we've talked about inflation on the program before, and what a modern capitalist economy can withstand, I should say. The Fed's target rate is at 2%, but modern capitalist society economy, I should say, can stand 2.5 or 3% inflation, even in some instances 3.5 and 4. Now, as far as deficits, has been much about that. She gives us an example, that is Dr. Kelton. Japan, who their deficit is 200 whatever times their GDP. Now, the U.S. is basically about a $19 trillion economy, larger than Japan's, the largest one in the world. So when you look at deficits, much of the old theory of deficits has long went out the window, and we'll talk a little bit about that in terms of lower deficits. We had that on the Wild Bill Clinton, where the deficit was down. Several of the political parties in the U.S. have both the Democrats and Republicans have talked about in the past debt reduction. On state levels, they have what's called a balanced budget trigger, where they cannot run a deficit. But in modern times, since the 2016 election under this present administration, the Trump administration, there has been a de-emphasis on deficit reduction. Now, there's some that still believe in that, but this is where you get into a difference of policy differences here, when things are needed that you need to do in your economy. Basically speaking, you can run higher deficits, for instance, to take care of the cost of Medicare for all, because actually on the front side you run up a deficit, but things tend to stabilize in the next 4 to 5 years. The same there when you talk about investments in education. College for all, as Bernie Sanders called it, so-called free stuff. It's actually not free stuff. But at the same time, you have infrastructure. Several schemes to take care of infrastructure programs, everything from the neo-liberal public-private partnerships, a bunch of toll roads, etc., coming in with the idea of that way of financing at least the highway part of it. But that is a phenomenal situation when you let your infrastructure run down and when you let your education system run down, and you really don't have a viable economy. And that is one of the big problems at this juncture. Because of demographics, fewer people are born. The baby boomers are working longer, but when the baby boomers exit, what do you have? Many industries now cannot find workers, literally, because either they don't pay enough or there are no workers available in that particular geographic area. So those are some situations out there. And also since the Reagan administration in the 80s, there has been a de-emphasis on education. For those that were around in the 60s when there was a race to go to the moon, science and math were emphasized. More people were trained in science, math, engineering, you want to put that in, they call them STEM, than ever before. But because of the nature of a modern capitalist economy, engineering jobs were lost because of what they were doing, period. When I was at Jobs with Peace, we of course talked about the military as a zero-sum situation. In other words, when you invest in the military industrial complex making tanks and various weaponry, once that weaponry is destroyed or becomes obsolete, there is no value left in it, social value left there. Some would argue, well, there's some employment designing and building, yes, but very, very little. And that is a part of the problem there, and this is where the big debate is now. What do you do in terms of industries that can produce jobs for the future when you will have less people in your working environment? Not only that, because of increased emphasis now on algorithms, on self-driving cars, and generally on automation. Eventually that will cut into the number of jobs that are out there. So the economy has to be retooled for that day, and you have to retool your economy prior to when these things jump in. If you noticed that factories at one time employed thousands of people, now they employ hundreds of people. It is an exception to the rule today to see a manufacturing plant, let's say, employs 3,000 or 4,000 workers. Usually that's not the case. And also you see some of the industries that this administration has sponsored, they used to call it picking and choosing, like the mining industry and some of those. They don't employ large numbers of people. Now in Pacific areas, yes, they have created jobs. We can look at the upper Midwest in places like Minnesota and in Wisconsin, and if you go to Iowa on some of the jobs that they've created there. But these are very, very small jobs. And you look at the nation, and we'll get into that in a minute here, looking at some of the numbers here. We'll look at GDP in addition. So we'll dive into what is actually going on here. There's a little more to that issue. Let's go now to the PMIs. We'll do those first, and then we'll go to the people at the Bureau of Economic Analysis. We'll first do the PMI, the U.S. manufacturing PMI. The PMI dips to 18-month low in February. And the date on this, I believe, is the 1st of March. Let me make sure. Yeah. Anyway, February data stagnated. A soft but still a solid improvement in operating conditions across the manufacturing sector. The headline PMI slipped to its lowest since August of 2017, and slower expectation in input and new orders. Notably, the increases were slower than their respective long-run trends, with growth rates dipping to 17-18-month lows. Meanwhile, foreign client demand continues to rise marginally. A substantial upturn in new orders lead to a further rise in employment, and backlogs also increased. At the same time, inflationary pressures softened in February, and rates of both input price and output charged inflation eased in January, with the former edging down to an 18-month low. The seasonally adjusted ISH market final manufacturing PMI posted at 53 in February. It's down from 54.9. Anything above 50 is seen as positive. Midway through the first quarter of 2019, manufacturing firms indicate a solid but softer improvement in the health of the sector, with the index registering its lowest in 18 months. Production increased further in February by a slower pace. Panelists reported that upturn stemmed from a substantial expansion in new business efforts to clear backlogs. That said, the rise in output was modest overall, with growth softest since February of 2017. Similarly, new business received by manufacturers expanded at a slower pace. That's the theme going on here. And on the price front, input cost inflation eased to an 18-month low, partially because of petrol oil prices going down. Increase in purchasing prices was needlessly sharp, reflecting high raw materials costs, and tariff. Factory gate prices rose as solidly, at a slower rate since December of 17. Finally, expectations towards one-year outlook remains positive. There, panelists were buoyed by forecasting further upturns in new business. This is from Dr. Williamson. He's the chief business economist. The PMI indicates the U.S. manufacturing sector is growing at a weaker rate for 1.5 years, with firms reporting marked easing in production growth in February, linked to a similar slowdown in order book growth. The survey exhibits a strong advance correlation with comparable official data, and suggests that factory production and orders growth rate are close to stalling midway through a strong January. Export markets remain the principal drag on the order book, having seen demand grow faster than production throughout much of 2018. Order book and output trends have come back in line in recent months, hinting that an evaluation of capacity constraints, and as demand cooled back, logs of work barely rose as a result, and price pressures have likewise moderated throughout. Tariffs were again reported to have pushed costs higher, and hiring has consequently slowed. Worries regarding the impact of tariffs, and this is some anecdotal news that perhaps an agreement between the U.S. and China is in hand, but it's not there yet. trade wars alongside with wider political uncertainty undermines business confidence, with the expectation of future growth running at one of the most subdued levels seen for 2 years, suggesting downside risk prevails for the coming months. And basically what Dr. Williamson is saying here is that the outlook, this is in Q1, is not as good as, say, in Q4. And we usually see Q1, that's the first quarter, as a transitional quarter. That's not unusual, because in years past we've had either a weak Q4 or fourth quarter the previous year, or a weak Q1. Climatic conditions and other things can affect that. So we'll be watching that. Let me move here to China. This is the China General Manufacturing PMI. The summary here is operating conditions faced by Chinese manufacturers are broadly stable in February, encouraging both output and total new orders expanded slightly despite export sales slipping back into contraction. At the same time, capacity pressures continue to build, with backlog of work rising further. However, efforts to contain costs combined to a future decline in employment and inventories, and at the same time a relatively subdued demand outlook weighted on purchasing activity, while the confidence towards the year ahead edged down slightly. So that is basically where China is, and the key points here: renewed rise in output as the total business picks up. Backlog continues to rise, but employment trends remain subdued. And basically, selling prices increased for the first time in 4 months. This is a comment here by Dr. Zahn, Director of Macroeconomics and Analysis at the CEBM Group. The China General Manufacturing PMI picked up to 49.9. Remember, these are at 50 from a recent 48.3 in the previous month, pointing to an easing in the economic downturn. The Subin index for new orders returned to expansionary territory in February after staying in contraction for 2 months, despite slipping back into contractionary territory following a rise in the month before. The gauge for new export orders hit at the second highest level since March of 2018. Domestic manufacturing demand improved significantly, and foreign demand was not deteriorating as quickly as last month's. The output sub-index also returned to positive territory. The employment sub-index dropped slightly further into negative territory, suggesting that no sharp rise in pressure on the jobs market. The measure for the stocks of finished goods fell further into negative territory and reached its lowest level since May of 2016. The sub-index for stock of purchased items picked up recovery, staying in a negative territory, indicating a marginal recovery in a manufacturer's willingness to replenish their inventories. The sub-index of supplier delivery time fell further into negative territory. Both gauges for input costs and output costs picked up, while one for output charges rose notably, implying that the year-on-year growth in the producer price index was likely to pick up slightly in February. Overall, with the early insurances of local government special purpose bonds and targeted adjustments to a monetary policy. The situation in manufacturing index sector, recovered markedly in February due to the effects of increased infrastructure investment and price industrial products also picked up due to improvements in demand and rebound in international commodity prices. However, the pressure on manufacturing capital turnover becomes obvious again, which may reflect that the financing environment was not easing as expected, and the effects of credit expansion is not yet there. So that pretty much sums up the Chinese situation. Let's go to the gross domestic product and related percentages from preceding. This is dated the 28th of February. Gross GDP in 2016 was at 1.6, in 2017 at 2.2, in 2018 at 2.9. So if we look to, let's do it quarter by quarter here. In the first quarter of 2018, it was 2.2. An outliner here at 4.2 in the second quarter. That's of last year, and in the third quarter, 3.4. So you had two higher than expected quarters, and now it's back to 2.6. That is your GDP. Let me just personal consumption expenditure. We'll look at it from this year. In the first quarter of last year, it was 2.2. It was It was 0.5 tenths, and in the second quarter, 3.8, and 3.5 in the third quarter, and now 2.8 in the fourth quarter. Durable goods at we'll just give it 4 quarters here at 5.9. Non-durable goods at 2.8. So we look at the 4 quarters. The first quarter of last year was a negative 2, and then we had these outliners coming in 8.6 in the second quarter. That's a durable goods, and then we had 3.7, and now 5.9. For non-durable goods, it was 2.8. For services, 3.4. And services have sort of been lagging here. That best quarter was the second quarter of 2018 at 3. And if we look at fixed investment, private domestic investment, we had 4.6 in the fourth quarter, and in the third quarter it was 15.2, and it was negative 5 tenths in the second quarter. So it's sort of up and down here. Intellectual property products at 3.1 in the fourth quarter, and it was 5.6 in the third quarter, and 10.5 in the second quarter of 2018. I will append this, so I won't go over all of these. Government consumption expenditures and gross investment for last quarter, it was 4 tenths. Started out in the first quarter as 2.4 tenths. With the federal government, it was 1.6 tenths. That was in Q4. In Q3, it was 3.5, and 3.7 in the second quarter, and 2.6. National defense. In the fourth quarter, it was 6.9, the best for the year. And non-defense, it was a negative 5.6 in the that was in the fourth quarter of last year, and in the third quarter, it's 1.6, 5 tenths. In other words, the federal government, state and local government, in the fourth quarter, a negative 0.3 tenths percent. In the third quarter, it was 2, and in the second quarter, 1.8. So So gross domestic income, that's what we call GDI. We just give the fourth quarter. It was 4.6. The average of GDP and GDI at 4. We don't have it for the fourth quarter. And gross national product, GNP at 3.1. Current disposable personal income, something we look at. It was 4.2 in the fourth quarter, 2.6 in the third quarter, 1.8, and the highest was in the first quarter of 2018. So we look at in current dollars, and we look at GDP 4.6, and we look at the average of GDP and GDI. Well, the third point is at 5.5. What else do we have here? I think that's all we have. Percentage of change at annual rates. This is gross domestic product. We'll give those for the year. It was at in the first quarter was at 2.2. In the second quarter, this is 2018, at 4.2 and 3.4, and finally 2.6. And we look at some of the subcategories here. Household equipment, it was at a negative 0.5. Recreation vehicles at a negative 1.5, and 0.9 other durable goods, non-durable goods at 0.39. That's in Q4. You can tell there's not very much going on there. At 0.6, that would be clothing and footwear. Gasoline and other energy products at 0.3. That was in Q4. Services, household consumption at 0.2. That's in the fourth quarter. Housing and utilities at let me see here, 0.21. Healthcare at 0.37 there, and transportation at 0.7 there, and recreation. Let's get food in here, because food's very, very, food and accommodation, negative 1.8. And let me see as we dig deeper down here. Okay. Federal government consumption expenditures and gross investment in the fourth quarter was 0.7%. National defense at 2.5%. Consumption expenditure at 0.15%. This is in the fourth quarter. Gross investment at a negative 1.5%. State and local governments at a negative 0.3%. Oops. Yeah. Consumption expenditures at 0.04 and at a negative 0.07 and 0.07. This is gross investments here. And let's see what else we can get up here. Well, not very much. We'll just append the rest of this. Okay. Now, personal income outlays. This is in December of 2018. Personal income outlays in January. Personal income in January of 2019. And let me just get this. Personal income in current dollars in January of 2019, a negative 1/10. It's in current dollars. In chained dollars, $2012, you have anything going on and all that. It was at 1 in December. That would be of 218. And the PCE, let's see, we don't have it there, but we do have it for December at 1 at 0.1, and if you exclude food at 0.2. And percentage change from 1 year ago, the PCE, we just have it for December. That would be at 1.7, and excluding food 0.19. And I think this is compensation of workers. This is personal and disposable income on March the 1st. And if we look at it, compensation of workers at 992.1, which is in salaries at 9.41 there, and goods and pricing at 7.614, manufacturing at 1.419, and government, we'll give that category here in January at 1399.9, and that is in billions of dollars. Is how they have set it up, is the adjusted annual rates here. So that would be compensation at $17,992,000,000 there. And rental income of persons with capital consumption adjustment. Personal income receipts at $2,782,000,000. Just some of them as we fill them out here to you. Personal income and its disposition. Anyway, compensation for workers, I think we gave that one before. It's 17,888,200, and wages and salaries at 11,221. Supplement to wages and salaries is employees' contribution for pensions funds and insurance here. Again, this is in billions of dollars here. To 43.8 here, and personal current transfer receipts. I don't think we'll get into that one. This is another table here, personal income and its disposition, change from a preceding period a month, and this is in January of 2019, a negative 23.8. Wages would be at 30.6, and so forth and so on. We won't go into as much detail as we once did reading all the tables here. You can look at the tables. Anyway, let's head back here. The modern monetary theory is not a receipt for doom. This is Dr. Stephanie Ann Kelton of Stony Brook. Paul Krugman talks about, he first wrote about what's called modern monetary theory. That was in 2011. He wrote about MM in a two-part series. Also this year of 2012 and 2013. Only had almost a decade to come to terms with the approach. He's still getting some of the basic ideas wrong. This matters for two reasons, because people listen to Paul Krugman, no doubt about it, who won the Nobel Prize in 2018. It's the Economics Prize. And two, because the approach he's discussing at the heart of how to design economic policy that affects millions of Americans. I like to try to move the conversation forward by addressing his concerns. He begins saying that modern monetary theory seems to be pretty much the same as Aber Lerner's functional finance doctrine. That's in 1943. Then Dr. Krugman then sets out to critique Lerner's functional finance, and he says it applies to MMT as all modern monetary theory. Actually, it's not correct to say that modern monetary theory is pretty much the same as Lerner's as functional finance. It draws MLT draws insights and inspiration from Lerner's work. I read this before, including his money as a creature of the state, but American academics who are most associated with modern monetary theory would argue that the contributions of Hyman, Minsky, and Wing-Godley are at least as important to the project, and probably more so as a critique of functional finance is not a critique of MMT, but a critique of one component, part of a broader macro approach. But let's go ahead and examine what Krugman thinks it is, and Aber Lerner gets wrong. For those who are not familiar with Lerner's approach, here are the thumbnail versions. The government should use its fiscal power, spending, taxing, and borrowing in whatever manner best enables it to maintain full employment, price stability. That's the Fed's mandate. Basically, he's saying that Congress and not the Fed should have the dual mandate. Lerner's abhorrent doctrine of sound finance, which held that a deficit should be avoided, instead of urging policymakers to focus on delivering a balanced economy rather than a balanced budget. Now, that is the one thing to remember about modern monetary theory. And where it runs contrary is we talked about in introduction, states having balanced budget amendments. So in other words, they're handicapped. This might require persistent deficit, but it might also require a balanced budget or even a balanced surplus. It all depends on how close the private sector comes to delivering full employment on its own, and in some cases the government should focus on inflation and not worry about the deficit or debt per se. Krugman says there are two problems with Lerner's thinking, and by extension with modern monetary theory. First, Lerner neglected the trade-offs between monetary and fiscal policy. Specifically, Krugman complained that Lerner was too cavalier in his discussion of monetary policy, since he called for interest rates to be set at the level that produces the most desirable level of investment, and that's what some Wall Streeters have, without saying exactly what the rate should be. In an odd critique, since Krugman himself subscribes to the idea that monetary policy should target an invisible neutral rate, and we talked about neutral rate here before, a so-called R star that exists when the economy is neither depressed nor overheating. And for what it is worth, research suggests that the neutral rate may be flattened out wrong. And the chairman, Jerome Powell, has admitted that the Fed has been too cavalier in relying on the variable that cannot be measured directly, which can only be estimated with great uncertainty. But Lerner wasn't trying to use interest rates to optimize the economy. That was the job of fiscal policy. He argued that government should be prepared to spend whatever is necessary to sustain full employment without raising taxes or borrowing, unless it is risked creating an inflationary problem. Lerner wanted the government to cut taxes and spend newly issued money and just leave it in the economy. But he also understood this could cause interest rates to be reduced too low, and this some have argued that's what had happened, and induced too much investment, thus bringing about inflation. That's pretty much where the economy is now. For that reason, Lerner suggested that governments might want to sell bonds in order to mop up excess money reserves to the point that short-term interest rates rose enough to prevent excess investment. Otherwise, low interest rates brought about by rising deficits might crowd in and more investment spending and overheating of the economy. In other words, Lerner has a complete different way of thinking about the relation between deficits, interest rates, and purpose of borrowing. He was worried about the potential crowding in effect of fiscal policy, not the crowding in effects that Krugman believes are part of inherent tension between trade-offs between fiscal and monetary policy. Lerner understood that deficits can drive interest rates down and spur too much investment, thus this support of bond sales to maintain higher interest rates. In other words, borrowing was not about financing deficits, but hitting some desired interest rates. And of course, MMT agrees and makes the same point. Krugman's other objective is that Lerner didn't fully address limitations of both technical and political on tax hikes and spending cuts as a means of fighting inflation. First, Lerner actually had quite a bit to say about this, and this is in 1951 when he wrote in a single sentence in the entire chapter of the 51 book, The Economics of Employment. We have now concluded our treatment of economics of employment, but a word or two about adding on the politics and administration of employment policy in general, and of fractional finance in particular. Here Krugman's concerned what lawmakers make a policy the way Lerner thought they should, and put in a situation where somehow down the road we end up with debt to GDP ratio of 300%, and the interest rate that is higher than the growth rate. Krugman, to stabilize the ratio of debt to GDP would require a primary surplus equal to 4.5% of GDP. That he wondered how we were going to get there, and we're going to slash Medicare or Social Security. They've talked about this in the past. I have three responses. First, there is a devil in the interest rate assumption, as economist James Galbraith, that's the son of John Kenneth Galbraith. Preventing a doomsday scenario is not difficult, as Galbraith explains. The prudent policy conclusion is keeping the projected interest rate down, or putting it more clearly, the interest rate is stupid. Since interest rates are policy variables, then all Feds have to do is keep the interest rate low, below the growth rate, to prevent the ratio from rising indefinitely. As Galbraith put it, there is no need for radical reduction in future spending plans or for cuts to Social Security or Medicare benefits to advance this, rather than preserving presenting this problem for functional finance, Krugman should be wondering why the Fed would ever maintain an interest rate that would put the debt on an unstable trajectory. I don't believe it would. This hypothesis scenario begs the question: why would inflation targeting Fed permit I less than G with debt to ratio at 300%? Let me finish this up here because you'll hear it from her. The modern monetary theory framework rejects this, since government deficits are shown to be a source, not a use of private savings. Some careful studies show that crowding out can occur, but it tends to happen in countries where the government is not a currency issuer. Now we have that in some emerging countries in Africa that they depend on, say, the Treasury of France. It seems like, and this also happened in the Russian Federation when they tied their currency. Anyway, this seems like a disagreement we should be able to resolve, either empirically or intuitively. But who knows? A learner, a man convinced against this, will retain the same opinion still. This is sort of a ring around the roses here. One possible alternative: the Fed could raise margins of safety on lending, such as a low minimum loan-to-value debt servicing to cash flow. Less credit would be extended, consistent with the Fed's government of slowing the economy. Well, that has happened. While interest rates on the national debt would not rise, a potential benefit to raising margins of safety compared with raising short-term rates is that credit extended could come with reduced risk of deficits. Let me just get one of a paragraph. It seems too extreme. Why not restrict duration to 3 months of T-bills, so interest rates could always set within half the overnight rate? If we wanted to embark on a World War II-like modernization for the Green New Deal, Congress could instruct the Fed to cap interest rates the way it did during the actual mobilization for World War II. In other words, there are ways to deal with technical administrative problems that occur that concern Krugman. And there could be no doubt about that. So the general takeaway from this whole situation is that monetary theory can be adopted to the present time or present crises. And that is what they are trying to say here, and it is not easily stated. I'm not sure. This is Dr. Kelly, Dr. Stephanie Kilton here, and her idea of modern economic theory. So, is, as Wikipedia calls it, hexadarchs of microeconomic theory that describes the currency as a public monopoly and unemployment as evidence that a currency monopoly is restricting the supply of financial assets needed to pay taxes and satisfy saving desires. The approach to modern monetary policy typically reverses the theory of government austerity. Government austerity has never worked, period. It's seen as an evolution of as chartalism. In sovereign financial systems, banks can create money, but the horizontal transactions do not increase net financial assets, as assets are offset by liabilities. The balance sheet of government does not include any domestic monetary instrument on the asset side. It owes no money. All monetary instruments issued by the government are on its liability side and are created, destroyed with spending, taxing, bonds, etc. here. So this is it, and we haven't explained it. Well, there are many that are trying to explain this in some sort of way. Let me go to the stocks and do the numbers here. Hopefully. Alright, let's go to the Asian Pacific. This is from Bloomberg. The Nikkei, what do we have here? .02% was a change here. The topic index, this is also in Tokyo. We have a 0.73 there. The Hang Seng at 0.51. And what else do we have here? It's in Asia, we don't have much. And the rest of Europe, the FTSE 100, let's see, the net change there was 3.3 on the FTSE, the DAC at 5.56, and in France they were at 24.97, and in Spain they were a negative 6.90. Euros at 0.52. I said East Africa, I hadn't found anything there. Anyway, the Dow was, what's the change there? 110.32. And the S&P 500 at 19.20. The NASDAQ Composite Index at 2.82. Is what we have there. And let me see what we can find in the Americas here. We've done the Dow. I suppose we can give Argentina here because we are dealing with the Americas here. The change a negative 1.76. We'll do the percentage changes here. This is for Argentina. Peru at 0.41 for Peru. Brazil all negative here at 0.69 in the negative in Brazil, and in Mexico negative 0.49 percentage there. Canada at 0.45, that's in the positive in Canada. Chile at 0.21% in the negative in Chile. In Venezuela, and this is, I haven't done Venezuela here, at 5.70, that's the percentage change there. In Costa Rica, 0.08% there. Panama, let me see here. Why would they put it in no change? Jamaica at 0.84. Colombia at 0.747, and finally Bermuda at let me see, no change. Okay, that's the Americas. We had not done the Americas. Kind of interesting here. And let's go over and look at the BBC. So we have this kind of well-rounded, we hope. But it's interesting to see Brazil was doing well. Some of the data here from the old BBC. We gave the FTSE at 0.44%. That's the 100. And if you want to do the 250, that's at 0.0%. We didn't do Amsterdam. Amsterdam at 0.28%. The Calc we at 0.47%. The DAC at 0.03%. Eurostrasse at 0.14. In Madrid, they were in the negative at 0.19 in the negative there. We didn't give Chicago, that's at 0.69 in the positive. And in Bombay, 0.55% there. The Hang Seng in Hong Kong at 0.51%, and Nikkei at 1.02. And let me see, what else do we have here? Oh, the commodities. Brent crude was up $1.15 at $65.82. West Texas Intermediate, they used to call it, was at 90 cents, basically at $56.30. T-Boone chicken is jumping for joy. Gold went down 1.17 at $1,309.85. Natural gas was also down 0.47% there for natural gas. So that is our market data here from the BBC and also from Bloomberg. And we run overtime here. Hopefully we shed some light, and Dr. Stephanie Kilton will come and she can talk more about modern monetary theory. I look at it more as a transitional theory, and we also, I'm going to have to just come to heart here. We have testimony of Jerome Powell, and it would be too long to put it here, so I'm going to have a separate episode and explain his Humphrey Hawkins testimony at the Senate and also with the House. And this is very important because then you'll see current Fed policy as opposed to what is called modern monetary policy there. And of course you see fiscal policy. A big debate, but it will become much clearer the Fed is more and more following what we'll call modern monetary policy because simply some other things just do not work. Nonetheless, this is This Week in Economics on the 4th of March, 2019 from WBRN Radio and the Numbers Man side of the network. Have a good week, everyone, and for those in business, make it a productive one. And for the consumer, keep your eye on the prize. And did we have the consumer spending? That has been down. Well, we'll throw it in on the Fed report. We'll get it in here. Good day.
Of Alexandria Ocasio-Cortez and Bernie Sanders.
I think the first thing that we need to do is break the mistaken idea that taxes pay for 100% of government expenditure.
My critics say, Bernie, that's a great idea. You're into all this free stuff. How are you going to pay for it?
So MMT starts with a simple observation, and that is that the U.S. dollar is a simple public monopoly. In other words, the United States currency comes from the United States government. It can't come from anywhere else. So what that means is that the federal government is nothing like a household. In order for households or private businesses to be able to spend, they've got to come up with the money, right? And the federal government, it can never run out of money. It cannot face a solvency problem, bills coming due that it can't afford to pay. It never has to worry about finding the money in order to be able to spend. So the deficit definitely matters. It's just that it matters in ways that we're not normally taught to understand. Normally, I think people tend to hear deficit and think it's something that we should strive to eliminate, that we shouldn't be running budget deficits, that they're evidence of fiscal irresponsibility. And the truth is, the deficit can be too big. Evidence of a deficit that's too big would be inflation. But the deficit can also be too small. It can be too small to support demand in the economy. And evidence of a deficit that's too small is unemployment. So if you think of the government as the difference between what the government spends into the economy and what it taxes back out, then imagine a government that spends $100 into the U.S. economy, but it only taxes 90 of those dollars back out. we label that a government deficit, and we record that on the government's books. But what we forget to do is pay attention to the fact that there's now $10 somewhere in the economy that wouldn't have been there otherwise, that is put there by the government's deficit. In other words, their deficits become our surpluses. And so when we talk about red ink and the government having all of this red ink, we have to remind ourselves that their red ink becomes our black ink, and their deficits are our surpluses. And the question is then, should you expand fiscal policy? Should you run bigger budget deficits in order to boost growth? So what is the objective? What is the proper policy goal? And I think the right policy goal is to maintain a balanced economy where you're at full employment, you're guarding against an acceleration in inflation risk, and economists tend to understand that the kinds of things that you can do to boost longer-term growth are investments in things like education, infrastructure, R&D. Those are the sorts of things that tend to accelerate activity growth so that longer-term real GDP growth can be higher. So there are ways in which the government can make investments today that increase deficits today, that produce higher growth tomorrow, and build in the extra capacity to absorb those higher deficits. So it's impossible really to put a number. Nobody can. How much debt is too much debt? If you look at Japan today, you see a country where the debt to GDP ratio is something like 240%, well above, orders of magnitude above where the U.S. is today, or even where the U.S. is forecast to be in the future. And so the question is, how is Japan able to sustain a debt of that size? Wouldn't it have an inflation problem? Wouldn't it lead to rising interest rates? Wouldn't this be destructive in some way? And the answer to all of those questions, as Japan has demonstrated now for years, is simply no. Japan's debt is close to 240% of GDP, almost a quadrillion, that's a very big number, yen. Long-term interest rates are very close to zero. There's no inflation problem. And so despite the size of the debt, there are no negative consequences as a result. And I think Japan teaches us a really important lesson. If you think about what happened after World War II, and the U.S. national debt went in excess of 100%, close to 125% of GDP. If we were talking about it the way we talk about it today, as burdening future generations, as posing a grave national security risk, we would have to scratch our heads and say, wait a minute, do we think that our grandparents burdened the next generation with all of those bonds that were sold during World War II to win the war, build the strongest middle class, produce the longest period of peacetime prosperity, the golden age of capitalism? All of that followed in the wake of fighting World War II, increasing deficits, massively increasing the size of the national debt. And of course, the next generation inherits those bonds. They don't become burdens to the next generation. They become their assets. The only potential risk with the national debt increasing over time is inflation. And to the extent that you don't believe the U.S. has a long-term inflation problem, you shouldn't believe that the U.S. is facing a long-term debt problem. So the best defense against inflation is a good offense. And what MMT does is to try to be, I think, kind of hypersensitive to the risks of inflation. I don't see any other macro school of thought pay as careful attention as we do to the inflation risk question. And so what we would say is, look, if you are Congress and if you are considering a new spending bill, instead of thinking about the ways in which that spending will add to the deficit or add to the debt, you should be thinking about the ways in which that new spending has the risk of accelerating inflation, and then avoid doing that. So instead of going to the Congressional Budget Office and saying, we'd like to know what this bill will do to the debt and the deficit over time, instead, go to the Congressional Budget Office or other government agencies and say, we're considering passing this $1 trillion investment in infrastructure. This is our bill. would you look at it? And we plan to do this spending over the course of the next 5 years. Tell us if that would create problems in the real economy. Evaluate the inflation risk and come back to us and give us some feedback. That's the kind of responsible budgeting that I think that I would like to see Congress begin to move towards. So the question about what to do if inflation becomes a problem is a different one. And I think the first thing you have to do is say, what is driving the inflation? Because to think that the inflation that is going to become important at some future date is likely to be the result of too much aggregate spending is really hard to believe. I mean, the U.S. economy hasn't experienced what we might call demand pull inflation for almost a century. The types of inflation that have been important in the U.S. have almost always come on the cost side, what we call cost push inflation. They come about because of things like oil price shocks. You might see increases in headline inflation rates because the housing component or healthcare. And so when you think about how to fight inflation, if you've got inflation resulting from energy price increases, it's probably not going to do much to have the Fed raise interest rates or even to have Congress raise taxes. You've got to do something else that's going to work. So I reject the idea that MMT is about using taxes to fight inflation. That's a mischaracterization of pretty much everything we've written, but people say it all the time.